Wednesday the 15th, good morning. Let's talk about what's going on. So markets are trying to move on from the war with Iran. Basically, hope is growing that talks will deliver some form of de-escalation. That said, the Strait of Hormuz very much still closed. Shortages are continuing to grow. It is a busy morning for earnings as well. We've got ASML on deck. We've got Caring. We've got Hermes. All of these big stocks, Anna, very much in focus this morning.
Yeah, absolutely. As you say, markets are trying to move on and to some degree successfully moving on, it would seem, from a focus on war in the Middle East. The problem is if you're long stocks, that doesn't necessarily mean a positive picture for European equity markets. And that has to do with earnings. We'll come to all of those earnings stories that you mentioned, Guy, in a moment. So Euro Stoxx 50 futures down by 0.25%. S&P futures pretty flat, actually seeming to pick up something a little bit more positive in the last 20 minutes or so. Brent crude prices then, just keeping an eye on those because we are still watching the Strait of Hormuz. Pretty flat. Flat to positive this morning, 95.31. The countdown to the opening trade starts right now.
Good Wednesday morning. Yesterday's session was pretty epic in so many ways. You've got this kind of new narrative beginning to develop. The war will be over soon. Talks are going to lead to de-escalation. We can put that in the rear-view mirror. The US economy, even with the war hit, is probably strong enough to actually weather the storm and deliver a fairly decent economic outcome. We'll talk about Europe in just a moment, whether or not that is the case there as well. Europe looks a bit different. But the AI story is still on. The AI boom is still booming. Take a look at what is happening in the semi-space. Absolutely epic session yesterday. The Nasdaq surging. Do you believe all of this? Does it hold water? The Strait of Hormuz is still closed. Oil is still elevated. But markets want to move on.
Markets do want to move on, don't they? And let's just go around the world and think a bit more about where the markets are moving on. So we talked in the show yesterday about how the S&P was back to pre-war levels. We now see the same is the case for Taiwan, the Singapore Stock Exchange, the CSI 300. And the fact that some of those are in Asia is interesting, given the exposure of those economies to the products coming out of the Middle East. So that's where we are moving on, it seems. Treasury markets also, what is the role of treasuries? What mode? What's the primary focus for Treasury markets right now? At the beginning of the war, it was all about inflation fears. We had a brief period where we then worried about growth. And now, whatever the driver, we are, it seems, according to some of our colleagues reporting, positioning for increased demand and a drop in yields. In particular, on the 10-year, there's sizable positioning around a drop in yields to 4 to 4.2%, to that kind of range. Doesn't sound as if we're still worrying much about inflation then. So we're trying to move on from that fear as well.
If you listen to the bank CEOs yesterday, the bank CFOs yesterday, they were all telling a very positive picture over the States about what they are seeing. Basically, they've got an economy that they think is resilient enough to weather the shock. And the US consumer seems to still be in fairly good shape. And as a result of which, it's kind of, is it businesses? Are we back to where we were? Is it a new normal?
Right.
Whatever it is, it's still a fairly positive picture because AI is basically Strait of Hormuz versus AI at the moment, as far as I can tell. The AI boom is on. The semiconductor stocks are just going ballistic.
Interesting to think about the US consumer. Deutsche Bank putting out some research talking about how the dollar has given up most of its war gains, and actually thinking about now how the dollar might be weighed on by the consumer story in the States, because the responsiveness of the gas market over there means that actually maybe they're paying more of a consumer price than some of the other places in the world where the price at the pump is more controlled, even if the economy is more exposed. Shall we talk about what's going on with energy prices then and the Strait of Hormuz? Because it is still closed. It is closed by these two blockades that we know about. Although our colleagues reporting that Iran is considering a short-term pause in exports to avoid testing the blockade. And we saw that happening yesterday with the US having some success in turning back some 6 vessels, including the Rich Starry, which we put a great deal of emphasis on yesterday. Today's Rich Starry is moving in the opposite direction and testing the Iranian reaction function here. This is the Agios Fanurios I, and this is apparently heading to Basra. Yes, heading to Basra to load up on crude, which will then go to Vietnam. So this is very much not an Iranian focused vessel. So the Trump administration has no problem letting it go into the Gulf. Will the Iranians allow it to go in to pick up Iraqi crude and to exit again, crucially?
It's still closed.
Yes.
The shortages are still...
Well, it's still... I mean, we are seeing some traffic through, aren't we?
Well, how many was it before? 130.
130, yes. It's a fraction.
So we are dealing with fractions of what we saw before. So shortages are just building. The longer this thing goes on for, the longer we're going to have a problem for. And I think that is the narrative that we've got competing. You go back to the first conversation we had. Tech's doing really well.
Yeah.
Is that enough? Is the US economy enough? Is this... How long before these two things kind of collide again?
Yes.
And the market has to react?
I was reading an interesting comment from Michael Ball on the Markets Live blog, where he was talking about lots of reasons why the market wants to move on from all of the focus on war, but saying that the worst case shortages have just not shown up. And I just wondered if you need to say yet.
Yet, yeah.
Or whether we can call the all clear on that. But given the lags between getting the product out of the ground and around the world, it seems as if there's a lot I don't understand anyway.
Let's talk about earnings. ASML is up a lot this year. Over the last year, ASML has absolutely rocketed. So its stock has been flying, and it's been flying over the last few weeks as well, into this earnings report that we've had this morning. Now, the earnings report this morning is a kind of, you need to look at it two ways. Q2, maybe they're being a little bit more cautious. Full year, in terms of the sales outlook, they're being really quite positive and they're upping their guidance. Which of these do you focus on? Because the narrative coming out of the company is that actually we're sold out. That we are supply constrained, that we can't deliver what everybody wants. So which of these narratives? I am not surprised that we're taking a little bit of profit this morning, maybe. Yeah,
it does seem as if in Europe's attempts to move on from focusing on the war, we're not finding the positives in the earnings stories this morning, are we? Because as you say, there was one to find in ASML. They're not telling us a huge amount about what's going on in China, and the team talking about how, well, they are saying that they can accommodate a change in export controls around China in the new guidance that they have given. So I suppose that's a bit of a positive. But there isn't a huge amount of mention of China, and maybe that is still an area of concern for markets. We've also got numbers out of Hermes, and I think this is interesting because first quarter sales at constant FX up by 5.6%. Here again, we've got a company disappointing against estimates, and we're not that used to Hermes disappointing. No. This is a company that Andrea Felsted likes to tell us doesn't face much competition, maybe facing a little bit. And actually, the Middle East stands out here as an impact, saying that the UK, Italy, the Swiss market, Thailand, all hurt by tourism disruption, which I think is fascinating. So this isn't just a Middle East story that stayed in the Middle East in terms of its impact on travel and therefore luxury.
Early Q2, Middle East traffic down, but sales are starting to improve. So again, are we moving on? Are people initially people were shocked by what was happening around them, but then they get back to buying
Couldn't
Birkin
make
handbags.
that trip to Dubai that they'd planned.
Yeah, or maybe if you're in Dubai, you didn't go to the mall because for obvious reasons, and maybe now you're beginning to rethink about what you're doing next. Kering wasn't great either.
Yes, absolutely. And the ADRs initially jumped, but then dropped when people had time to sort of digest what was happening here. But again, there, to echo what Andrea Felster was saying about LVMH yesterday, some of the underlying drivers not looking too bad, whether it was the North American market or some of the non-Gucci businesses, but then the focus is on Gucci, and it's on the turnaround over at Gucci.
It's a fairly big portion of that business. What have we got coming up on the show? We're going to talk more about what is happening with that luxury space. Yelena Sokolova is a Morningstar senior equity analyst, going to be joining us shortly to talk about all of that. Louise Dudley, Federated Hermes Global Equity Portfolio Manager, will be joining us to talk about the wider picture. Emily Ashford, Standard Chartered's Head of Energy Research, will be joining us a little bit later to look at kind of the Gulf being closed and the ongoing impact that's having into the energy space.
Yeah, absolutely. Let's tell you about some of the other items we have on the agenda for you today. IMF spring meetings, they continue over in DC, so we'll continue to watch that. US earnings, Bank of America and Morgan Stanley will be on deck. We've had numbers. We'll talk about that in a moment. Later, we'll be hearing from the Bank of England's Bailey, the ECB's Schnabel and Villeroy, all speaking in DC. So there's a host of finance ministers and central banking voices set to speak over in Washington. So a lot of that news flow could come later in our European day. Later, we'll hear from Fed speakers, so Michael Barr, Michelle Bowman, 7 o'clock UK time, we'll get the Fed beige book out of the United States. The bank earnings story then has been quite interesting. I'm not sure I took away one clear message yesterday. Maybe you did, Guy. But we had JP Morgan down. This is stock moves. JP Morgan down, Wells Fargo down, Citi up and BlackRock up. So there was, in terms of the stock price reaction, it's not the whole story, but in terms of that, it's quite divided.
The message I took away was trading is fantastic, and if you were a European bank and you were producing these kind of numbers, you'd be taxed a lot. But that's not going to happen over in the States. These guys are making a lot of money out of what we're seeing in terms of the turbulence we're getting on global markets, and it's not kind of gappy turbulence. It's nice volatility apparently, and the US economy is fine. The US consumer's fine. Apparently, everybody's got jobs and they've got wages and they're continuing to spend money. So nothing to see there.
Yeah, either. Not too much of an alarm bell around the US economy or around private credit, because that was going to be an area of focus. The linkages between private credit and Wall Street, well documented, talked about on this program a number of times. And there were some areas of disappointment. So Wells Fargo missing key estimates and no upgrade to guidance. So that seems to be enough to tank that. And JP Morgan dropping, despite the fact they had that record trading revenue up by 20% year on year. quite amazing. The market is quite discerning, isn't it? / fussy.
You've also had a good run. It's like ASML this morning. The stock has doubled almost in 12 months. So little kind of drop this morning. We're going to make a lot of noise about it, and European earnings are going to impact the European market open this morning. But ASML's had a really good run. JP Morgan's been has rallied into these numbers. And therefore, maybe just at the edge of the margin, maybe you take a little bit of profits.
I'm noticing that Hermes is expected to fall at the start of trade in Paris. So we'll certainly keep what's going on in Paris in mind when it comes to luxury. Interesting that despite seeing this coming for the luxury sector in Paris, we still find room for another leg downwards on some of these earnings reports we're getting. So we'll watch that. We'll also watch the Dutch market, of course, with ASML in mind. And thinking about the banking sector, remember that later today we will have interviews with Ted Pick, the CEO of Morgan Stanley, who will join after the earnings report from that particular Wall Street bank. We'll also be speaking to CS Venkatakrishnan, the Barclays CEO. That conversation at the IMF spring meetings.
Looking forward to all those conversations. What else do you need to know this Wednesday morning? The London Stock Exchange's CEO says the market currently has its largest pipeline of listings in more than 20 years. Speaking to Bloomberg at the HSBC Global Investment Summit, Julia Hoggett said the recent market reforms are attracting domestic and international companies to the UK.
The simple reality is we have the biggest pipeline we've had since 2005. So this reform agenda is bearing fruit. Our lawyers and our bankers are very busy right now in preparing transactions. And those transactions are coming in not just from the UK, but around the world.
Talking of IPOs, Bloomberg understands that Anthropic has received several offers from investors for a new funding round that could value the company at more than $800 billion. The offers would more than double the $350 billion pre-money valuation. Anthropic attracted to its $30 billion fundraising. That was just back in February. Bloomberg previously reported the company has discussed a public listing as soon as October. And the US Treasury Secretary Scott Bessent said President Trump's tariffs may be restored by July to levels that were in place before the Supreme Court struck down many of his pre-Supreme Court levies. Speaking at a Wall Street Journal event in Washington, Bessent said the administration is seeking to implement or conduct Section 301 investigations, including probes into other nations' industrial overcapacity and forced labor practices. These, he indicated, could give the US cause to implement new tariffs.
Back to tariffs then. We really are trying to move on, aren't we? Coming up on the programme, Christine Lagarde tells Bloomberg that higher energy costs have pushed the euro area away from the ECB's base case outlook. We will bring you some of that interview later in this programme, coming up very shortly, in fact. Plus, we'll take a look at the stocks to watch at the open, including the luxury sector. Paris in focus there after disappointing results from Hermes and from the Gucci maker Kering. Up next, we will be speaking to Luigi Speranza, Global Head of Markets 360 and Chief Economist at BNP Paribas. So we'll get thoughts there for certain on the Eurozone economy. If you have questions, if you want to get in touch with us, get involved in these conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg. Welcome back. 7:16 here in London, and this is the picture on European equity market futures. Globally, the narrative is we're trying to move on from focus on the war in the Middle East. That puts earnings front and centre here in Europe. We haven't yet made up for the ground that's been lost on European stock markets since the start of the war, but we are trying to focus on the earnings stories. That doesn't necessarily mean good things for stocks. CAC futures, I can see, down there by 0.2% or so. So we'll certainly focus on the luxury space and the earnings stories there. Let's think about the impact that we've seen from the war on the Eurozone economy. ECB President Christine Lagarde says reaching a settlement to the war is in the best interest of the global economy. In an exclusive interview with Bloomberg, Lagarde also discussed how the prolonged conflict has weighed on her outlook for growth and inflation.
I have seen successful program being completely wiped out by war. So war is, in any circumstances, the worst outcome. If you talk in strict economic terms and the movement of goods and all that, it's the Strait of Hormuz not being open for shipping and transportation, because you have 20% of gas and oil going through that, as well as the like of ingredients necessary for fertilizers, ingredients necessary for microchips, and what have you, not going through the strait.
So what's the pain threshold for the euro area economy that the ECB would have to act on? Is it inflation at 3-4%, or is it?
Look, we have forecasts for inflation that vary between 2.6, which is the baseline that we have, and a little north of 4%. Based on what I told you earlier, which is see-through, strong, decisive reaction, or somewhere in between, depending on the factors that we see, we will adjust because we will be agile. But one thing for sure is that we will keep our 2%.
Madame Lagarde, how worried are you about the discrepancy between spot and future oil prices, and so potentially tighter markets that we're pricing in?
I think it's the whole dilemma that we have about short-term and medium-term. And the more anxious and worried economic actors are about the resolution of this crisis, the more pressure there will be on the spot market.
How much do you blame the U.S. administration for what's happening to the European economy?
It's not my job to do, blame, to point finger or to associate this or that with blame. I'm more in the hope section myself, and I very much hope that people can sit at the table, can come to their sense, and understand that it will be in the best interest of the global economy, of the people, that a war settlement is reached, and that not just a ceasefire, and that we can navigate through the straits of the world.
ECB President Christine Lagarde speaking exclusively to Bloomberg's Francine Lacroix in Washington. A couple of sort of bits come out of that. One really stands out to me. We will keep our 2%. That is coming from Christine Lagarde. But what has been interesting is the pricing around an ECB hike has definitely faded over the last few days. We've gone from an 80% probability to a 30% probability in terms of market pricing around the next meeting, which is April the 30th. Is that about right? Luigi Speranza, Markets 360 Global Head and Chief Economist at BNP Paribas, joining us around the table to discuss. Good morning.
Good morning.
Nice to see you.
Thank you for having me.
Yeah, great.
And to your question about April, our central case at base case is a hike in June.
Right.
I think the ECB comments have been quite consistent. No rush, optionality, and need to see some evidence of second round effects. So higher inflation is not in itself sufficient for a rate hike, and I don't think by April the ECB will have this evidence. But there is also an implicit bias to tighten. We will adjust. And I think inflation will justify rate hikes in the future, so our base case is for June. So in a way, I agree with the market movements here. Markets priced out April, but June is still priced in, and we do agree that that's kind of reasonable base case.
Tricia used to talk about having a single needle in his compass, and that was inflation, and it was 2%, and she's talking about that as well. We will keep our 2%. Isn't there a danger that economic growth, though, becomes a problem? And I appreciate they have a single needle in their compass, and it is inflation. But isn't there a danger that actually the European economy... I was listening to the IMF forecast yesterday, and they are pointing to a sharp slowdown in the European economy.
I think it's more than a risk, actually. I think it's a reasonable base case now that you see a significant slowdown. Higher inflation means also lower growth. And, you have sentiment effects, you have delayed investment because tighter monetary conditions, you have a real income issue, which will slow consumption. That said, the probably silver lining is that there was strong momentum pre-crisis. I think this is an important offsetting factor. And so when I put the two things together, I think slowdown, but no recession, is a reasonable base case here. But the slowdown is a fact, I think, and will be increasingly evident in the data. Should this stop the ECB? I think that's the point. And here is a trade-off between short-term and medium-term.
Yeah.
Not acting might mean higher inflation becomes more entrenched, and you have to be even more aggressive in the future, slowing down the economy more. So the ECB has got this trade-off to consider, and I think kind of a reasonable approach is to be resolutive, decisive at the beginning, and the sooner you do, the less you have to do overall.
Luigi, I was talking to the Bundesbank yesterday, and the conversation was around how will things be influenced by recent experience, by the recent behaviour that we've seen from consumers and from central banks in 2020, in 2022. We've had periods of such volatility and high inflation. Do you think that maybe consumers and those who demand higher wages might react more quickly this time around because of that very recent experience?
That's a great point. Let me make 2 points here. One is we are not, it's not similar to 2022. 2022, what we had is an overheating labor market. Now it's probably tight, but not overheating. And inflation was already moving higher. So in a way, the conditions to start with are better. The ECB was neutral, and inflation is at 2%. It was actually going down.
Yeah.
That said, the key point you're making is very valid. There is muscle memory here. And I think, expectations are in some way adaptive. People expect what they've experienced recently. And so the fact that there was an inflation spike, I think increases the probability of this kind of propagation, second round effects. And that's why I think the ECB has a bias to prevent that, acting sooner rather than later and doing less rather than more. I think that's kind of the key point.
And how quickly do you expect to see these things pass into the economy on inflation and on growth? We spoke to a guest recently who talked about this coming in 4 waves of inflation. Some people talk about the inflation impulse coming early and and is evident in some of the data already, in fact, and the growth hit coming later. How do you view the timing of this?
Yeah, so in terms of inflation, it's immediate, but that's headline inflation. So, a spike in energy prices can still be seen as a relative movement in prices and one-off. I think the key point, if that translates into higher wage demand, if translating higher core prices, and I think we'll see evidence of that over the next 3 to 6 months. And at that point, I think you need to act preventively to avoid that these become more entrenching and, kind of create a persistent shock rather than what it should be a one-off shock.
Should European governments protect European consumers from this energy shock this time round?
I think there is a bit less space than in 2022, and this is part of the story. So they will probably, but not to the same extent. In 2022, the fiscal expansion in response also to COVID was massive. I would not expect that at this stage, which in a way will contribute to lower demand and help, if you want, the ECB, because the key problem is that to prevent inflation from becoming entrenched, you need to have slack in the economy. So you need to grow below your potential, and you need to distract some forms of demand.
Yes.
And so that will probably limit the extent of the ECB need to intervene.
And Luigi, how much do you expect the response from the ECB to contrast with the response from the Fed? Because the market seems, in our attempts to move on, the market seems quite keen to get back to thinking about Kevin Walsh at the Fed and what he might or might not mean, and whether there'll be a downward, at least, inclination.
They are in a different situation. I think the starting point, the ECB was a neutral with inflation at 2. The Fed has still a bias to cut rates. Well, formally still has. I think that will disappear with the next meeting with a move to a more symmetric bias. But I think that's a key difference here. The Fed is still in restrictive territory. And I mentioned also sort of the reaction function. There is probably higher tolerance for higher inflation because the Fed has a dual mandate. So I think there is a difference here. And, the Fed, for us, the base case is no move, a move to symmetrical bias, and a key focus on the labor market. So if the labor market deteriorates for whatever reason, then I think the bias to cut will come back. If the labor market kind of accelerates and the unemployment rate goes down, I think there is scope for rate hikes. Base case, nothing, effectively, for a very prolonged period.
Luigi, thank you very much. Good to see you this morning. Luigi Speranza, Markets 360 Global Head and Chief Economist over at BNP Paribas. Coming up, we'll get back to the earnings stories then. Hermes sales disappoint as the Middle East war disrupts demand, and not just in the Middle East. We'll talk to Yelena Sokolova, Senior Equity Analyst at Morningstar, about all the earnings from the luxury sector. That conversation next. This is Bloomberg. Welcome back. This is the opening trade, Wednesday the 15th of April, and 30 minutes from the start of the cash trading session. And we have European equity markets quite divided, actually. If you look at what's going on in the Dutch market and the French market, there's negativity in both of those around ASML and around the luxury story. And that's really the earnings story. And it seems to be weighing on markets today, Guy. Aside from that, the markets do seem to be trying to move on, don't they, from the focus on the Middle East?
European equity markets made decent gains yesterday.
Yeah.
And while you see a little bit of red on the screen this morning, we're basically holding where we were. So we had a really decent recovery yesterday. It looks like we're going to hang on to that. European bonds a bit this morning. EGBs are down kind of circa 2 basis points pretty much across the board. Big move down yesterday in the UK gilt market. We'll see whether that sticks. Obviously, there's a growth/inflation concern that we're working through here in Europe, and it looks like Europe may deliver a different response to what we're going to see over in the United States. And I think that's going to be an interesting theme throughout the rest of this year as the two maybe diverge. But let's get back to some of the corporate news.
Yeah, absolutely. And let's start with the luxury sector. Hermes shares indicated lower this morning after the company reported sales numbers that expanded at a disappointing pace. The Birkin bag maker was hit by the disruption caused by the conflict in the Middle East, like many of its peers within the luxury industry. Elena Sokolova is senior equity analyst at Morningstar, covers the luxury sector and is with us this morning. Elena, nice to speak to you. If we start with Hermes then, I mean, does this tell us something useful about the extent of the impact of the Middle East war and how it has been passed through into the luxury sector? Because they're talking here about the Middle East war taking 1.5 percentage points off the first quarter and talking about how tourism was disrupted in the UK, Italy, Switzerland, Thailand. This wasn't just what happens in the Middle East stays in the Middle East story from a luxury perspective.
Yeah, indeed. If you think about kind of the revenue contribution of this region, it's sort of 5 to 10%. But of course, these people also travel, so they impact the travel flows in different countries. And there is also incoming travel flows to these regions, especially in winter, that were obviously also impacted. It's also quite a profitable region for the industry, and it has been quite growing industry, one of sort of a few bright spots in this environment.
Yeah, and I mean, we when the war was in full swing, the market kind of saw this coming and was reducing exposure to some of the luxury goods companies, knowing that there would be exposure to travel and to the domestic consumption in the Middle East. And yet there's still room for these stocks to go lower on the back of these earnings results. Does that surprise you?
I think also what the markets have been looking at is the potential recovery for U.S. and China, notably. And that is happening, but it is happening much slower than market participants were anticipating.
Why? Why is it happening more slowly?
I think from one perspective, Chinese demand is still subdued. There is still real estate price weakness. Sort of we were almost out of the woods in terms of real estate prices. Now they turned down again. American demand is significantly stronger. So it is on a recovery trajectory. But again, it's not maybe as buoyant as people were expecting because of all the geopolitical tensions, the market's becoming a little bit more jittery, so that could weigh on the sentiment as well.
Who's got the right product right now? Who's looking good?
I think from kind of the revenue growth perspective, Cucinelli reported results that were still quite solid and accelerating. So they are targeting very, very high net worth consumers. Richemont has been growing also nicely, but of course they will be impacted by the Middle East conflict because just their exposure is higher. So there have been a few bright spots, especially like Hermes recently, but even Hermes is feeling some of the pain, right?
Yes, I mean, you talk about historically the sector facing downturns that last 1 to 2 years. Is there a typical downturn for the luxury sector? It feels like we maybe have a downturn on top of a downturn here because we had pre-existing concerns about China, for example, and to some degree the US as well. And now we have the war in the Middle East. Is it possible to say anything general about how long these downturns last?
Yeah, of course, every situation is different, right? And I think with this situation specifically, of course, luxury is very correlated to the GDP growth. And if there is spillover effects from the Middle East conflict, let's say on the oil prices, inflation, interest rate, the economy, markets, etc., there would be repercussions as well for American consumers, for European consumers, etc., etc. So that could additionally put kind of a leg down on this market, on this recovery that was kind of a little bit fragile to begin with.
What role do luxury stocks play in my portfolio if I want to put them in there? How do I think about them? I read in your notes this morning, they're kind of the antidote to the AI story. They're the kind of can't be disrupted. Is that how I think about the luxury trade? Is that going to hold up? Or is it, to your point about the relationship with GDP, is the cyclicality going to be something that that is going to be kind of problematic in that trade?
I mean, the cyclicality is part of the nature, but one can say that we are already probably closer to the bottom of the cycle than the top of the cycle, right? So that's typically for long-term investors is a better place to be because the valuations are depressed on top of depressed earnings. Right, so from long-term perspective, I think the sector is looking good. And as you mentioned, again, it's not facing kind of the technological obsolescence that many people are concerned about right now in the markets. So from that perspective, I think it's a good hedge sort of for the risk of disruption from either technology or emerging competition, let's say from Chinese competitors.
Elena, I went down a rabbit hole today reading about the 25 sort of boutique manufacturing locations. I don't think manufacturing is quite the right word, is it? That Hermes has in France. Yes, crafting locations that they have. And I was taken by a quote from the executive chairman where he says, "I was joking with a journalist yesterday who asked me how AI will transform Hermes. I told him the strength of Hermes is that we missed almost all the technological revolutions." I mean, and that's to your point, isn't it? And to Guy's question, what kind of resilience can this sector then demonstrate at a time when we see a lot of volatility around the AI story, but also a lot of excitement?
Yes, I mean, on the excitement front, I think these companies cater for wealthy people and especially for new wealth, right? So if wealth is being created by AI, they could, of course, benefit because those people would buy the products. But on the other hand side, like something that I'm concerned about longer term is potential displacement of high-wage jobs. Like we already see it on the entry level in sectors like tech or finance. These are not like low-paid sectors, right? So if that continues going forward, that kind of reduces the pipeline of new consumers for luxury.
Yes, if the wealth is more concentrated as a result of AI. I don't know how many handbags one person needs. That's a question we're not going to answer around this desk, are we?
Let's park that one. Many more than you think. I've just checked the weather in Florence. A bit grey today. Tomorrow looks a little more sunny. You're going there. You're going to the Caring Investor Day. What does Luca Di Maio need to deliver? What does he stick with them now? How does he fix Gucci? What needs to happen here?
Yeah, I think it's a difficult one because, of course, with designer bets, you kind of you take a bet. It's not, you cannot take small bets and see if they're playing out or not. You take a big one, and it delivers results probably in 1.5 years after the appointment, right? So they still have runway, I would say, to see if it works or not, because not a lot of Demna's products are in the stores. But I would like to hear, what kind of plan B do they have? Like, what do they do exactly if that doesn't work? Because I get the story that they have to improve also the operational performance of the group, reduce debt, etc. But like the key to the thesis is still reviving the desire around Gucci brand. So there would be questions around that and what their game plan is.
Elena, thank you very much. Enjoy the trip. Elena Sokolova, Senior Equity Analyst at Morningstar. And we will be speaking to the CEO of Caring. Catch our interview with Luca Di Maio. That's at 3:30 p.m. London time. That's coming up tomorrow, isn't it? If my eyes read that right. Yeah, Thursday.
What is plan B? There you go. That's the question that we need to be asking. Recession risk, very much on the agenda, though, today.
We have a classic energy price shock unfolding across the world as we speak. That, of course, will create demand destruction. It will cause economies across the world to decelerate. The risk of a recession has increased, and central banks are making some really difficult decisions. This really is a very, very treacherous moment for the world economy.
It's great for trading, though, isn't it? Ken Griffin, Citadel CEO, speaking at the Semaphore World Economy Summit taking place yesterday. This is Bloomberg. 60 minutes, 70 minutes to the start of European equity trading. Eurostoxx 50 futures are down. They're a little soft. I think we could probably blame ASML. That's a big chunk of that index. And it's looking a little softer going into the open this morning, Anna.
Yeah, absolutely. That and the luxury sector, those two areas of focus for us. As the market tries to think past what has been happening in the Middle East, let's get an update on the Middle East situation, though, because we are still looking out for headlines on that front. Bloomberg has learned that the US and Iran are looking to arrange a second round of peace talks in the coming days, with one proposal to return to Pakistan. Meanwhile, the US is pressing ahead with a naval blockade of Hormuz to curb Iran's oil exports. We've also had an update from President Trump in a Fox Business interview, reiterating that he sees the war as nearing its end.
I think it's close to over here. I mean, I view it as very close to over. You know what? If I pulled up stakes right now, it would take them 20 years to rebuild that country. And we're not finished. We'll see what happens. I think they want to make a deal very badly.
President Trump then suggesting that the Iranians want to make a deal. Let's get an update then from the Middle East. Our Bloomberg Horizons anchor, Jumana Basechi, is with us, of course, from Dubai. So another day where we're focused on the possibility, Jumana, of renewed talks, possibly coming in the next days.
That's right. And even President Trump has said it himself. He's spoken to multiple journalists over the course of the last 24 hours, suggesting that the next 2 days could be pivotal in terms of getting those second round of negotiations across the line. He even said the next 2 days will be amazing to an ABC journalist. And also, he sat down with Fox Business as well. You were just playing a little bit of the interview there, suggesting that the war may be close to the finish line. Now, of course, this is just President Trump himself. And I will also remind everybody that the Iranian side haven't actually confirmed anything. They haven't said anything. There are no new updates since the Iranian President Pezeshkian yesterday said that they were inclined to continue with negotiations so long as it's done within, quote unquote, the international framework of law. But we did report yesterday, these are our own colleagues at Bloomberg, that Iranian officials are considering halting shipments through the Strait of Hormuz over the next couple of days. They don't want to provoke or test the U.S. naval blockade that's in place in anticipation potentially of those second round of talks. But again, no confirmation from the Iranian side that they are going ahead, but plenty of discussion about where they could be held. Islamabad seems to be once again at the forefront of potential locations, but other locations, as we understand, are also throwing their name into the mix. Switzerland saying that they're happy to host as well. And then it just comes back to the essential issues, the principles of prior rounds of negotiations between U.S. and Iran. Obviously, not just about the Strait of Hormuz and the unconditional full reopening of the Strait of Hormuz, but that all-important nuclear file, and whether really you can realistically expect the two sides to come together out of one more meeting over, the status of enrichment, that highly enriched stockpile that they're sitting on. In prior cases, i.e. in JCPOA, the former nuclear deal, it took years to get these types of agreements across the line. So there's a lot at stake still. I expect we'll hear more in the next 24 hours.
Jumana, great stuff. Thank you very much indeed. Jumana Basechi in Dubai. From a market point of view, we've moved on. We're done. We've moved on. We can get back to trading the AI theme and everything else that we were trading beforehand. Neil Campling sent me a nice note this morning from our markets desk saying we're in kind of inverse panic. We've gone from oversold to overbought very quickly. There's been a short squeeze. The CTAs are in the market and buying big time. But are we nearing the limits of that? And where do we go from here if we are reaching the limits of that? Let's try and find out. Markets, the MLIV team have got a lot of thoughts on all of this. So let's figure that all out in 3 minutes. Its editor is Mark Cudmore, and he joins us now. Mark, what do you make of it all?
Yeah, I'm going to disappoint you, Guy. I think you summed it up absolutely perfectly there. First of all, that investors are trading as if the war is effectively over. And I think that is the correct approach from a macro investor point of view. Obviously, war is terrible. There's terrible things that happen in the region. It could continue to be really, really tough for the region for a long period of time. But, I think from an investment point of view, and I'm probably talking about markets here, not talking about the humanitarian side, that the rest of the world ultimately doesn't care if it's not going to kind of really blow up or escalate again. They just want to see that there's progress being made. They don't care the intricacies of what's a negotiated deal. They just want to know this is not going to get worse and we're on a path to recovery. So that's the why we're investing trading positive. Now, I think the second bit you kind of raised there is, we're trading as if the war is effectively over, but does that mean we can trade as if we can ignore it? I think what's still in debate is, how bad are those lingering impacts, stagflationary impulse, going to be? That's still really up for debate. Markets are kind of trading that, hey, actually, it turns out if the Strait of Hormuz is, closed for 2 months, as it might end up being by the time, we get some real traffic going through here, maybe the world is fine. Now, up until 2 months ago, we were told that the Strait of Hormuz was closed for more than 5 days, or maybe even 2 weeks. It was going to be catastrophic for the world economy. Now that clearly is not the case. But is the truth somewhere in the middle, or is the truth really that actually the Strait of Hormuz doesn't matter half as much as hyped? I'm in the camp that it's somewhere in the middle. I'm in the camp that, the supply chain disruptions that we're going to see are going to have a lingering impact for months. Now, the next question is, if you believe that, is where's that impact going to fall? And I think it might fall quite selectively. It's not going to hold back global indexes, but it's going to hurt certain sectors and certain countries worse. And I think that's the bit that people are really trying to analyse at the moment.
I wonder then, is it right to be saying that the shortages have shortages have just not shown up, or that shortages haven't shown up yet, Mark? And I wonder if we start to get further signs of, on that particular front, of shortages still yet to come, that could be something that reduces risk appetite, perhaps.
Yeah, very much. I think that is that dynamic, and we're having that debate very actively. And again, I think the answer is, like all these situations, it's probably a little bit more nuanced in terms of that there are certain sectors where the shortages are real but have not shown up dramatically yet, and they'll still impact. But in a bigger, broader sense, I think that maybe the impact won't be as large. And that's when I go back to I think that we're going to be trading the impacts of the supply chain disruption for months, but I don't think it's going to be the dominant theme. Now, will it even be a very major theme or just a minor subtext in certain sectors? That's the bit we're trying to work out. There's a chance that we might already be moving to a world by next week where really we're just back to trading the AI theme and what you think of the kind of the winners and losers from that and the kind of steps. And I have to say, I'm increasingly going towards that camp, but I'll stay open-minded for now while we continue to do more analysis.
Yeah, and the earnings stories, of course, will keep on coming, Mark, which will help with that pivot. Bloomberg Markets Live Executive Editor Mark Cudmore. Remember, you can get up-to-date analysis, insight, Mark and the team available to you. MLIV Go is the function on the Bloomberg terminal. Now let's get your stocks to watch. Chloe Melly has a rundown. And thinking of AI, let's start with the tech sector, Chloe.
Good morning, Anna. Indeed, we are starting with Europe's most valuable company this morning, ASML, which raised its forecast for full-year sales. But at the same time, the forecast for the second quarter sales actually came in a little lighter than expected. So we'll see what investors actually decide to focus on this morning. But as you said, AI is obviously a big theme, and the CEO said that the demand there was really solidifying, with customers accelerating those investments in AI. And of course, we've seen ASML shares do really, really well, with that big jump starting about 5 years ago and now hitting those record highs. But we'll see if today's results were actually enough to sustain that performance this morning. Moving on to luxury, and we had two big names reporting. So Kering last night reporting with Gucci sales falling more than expected, and then also this morning Hermes came in with results, and there these sales also disappointed, which is actually quite rare for Hermes, which tends to beat estimates. And so we'll see how the market reacts to that this morning. Both of those companies were really hit by the war in the Middle East, which has really hurt demand and growth in those Middle Eastern hubs and elsewhere for those companies. LVMH said the same thing yesterday and got hit quite bad in terms of the shares. So we'll see if that weakness extends today for Kering and Hermes. And finally, Spanish banks are also in focus. BBVA was downgraded and CaixaBank upgraded by Barclays, and the analysts have said that in an environment of higher rates, of lower growth, of higher inflation that is created by the Middle East, the investors' focus is going to be on kind of earnings visibility, on simplicity, and less so on that reliance on the benign macro backdrop, which is what the analysts have said. And therefore, they now prefer those more sort of defensive names like CaixaBank. So we'll see how both of those lenders today react to those rating changes.
Okay, Chloe, thank you. Chloe Melly, we'll be back later with a look at how those stocks are performing. And Guy, it's interesting that the luxury sector down year to date and set to drop further on the earnings story. ASML very much stronger year to date, but still we're expecting a bit of weakness. The earnings story negative, it would seem, at least in the moment.
ASML over the last few days has been absolutely surging. You've seen this semiconductor story developing on both all around the world. You've seen it in the United States, you've seen it in Asia, to a certain extent here in Europe. ASML has been the biggest beneficiary of that. So the stock has been rocketing higher. So any kind of at the margin miss, and we're talking about Q2 here on the full year outlook, the market's going to go, it's just a good opportunity to maybe take a few chips off the table, maybe. Yeah,
it seems so, because there were positives in there. There very much were positives around the full year guidance and the Q2 guidance, a bit of a negative distraction maybe from that. But we'll keep an eye on ASML, we'll keep an eye on the luxury sector. Overall, though, so we've been telling this story about how markets want to move on from war in the Middle East, and that does seem to be, certainly that was the case yesterday. European stocks doing really well, the Asia session doing well today, US stocks did well yesterday. US futures are flat now, looking for a new direction, it would seem. And you wonder where the banking story, is there going to be room for that to cut through more meaningfully? So you've had a short squeeze, which has been substantial. You've had the CTAs coming back into the market. They were massively underpositioned. And now they've had to basically correct that, and the buying has been really substantial. Again, if you look at the volume numbers and you look at kind of what is happening here, the volume is actually reasonably muted, which suggests that there's been key buyers that have been in this market that have been pushing it to the upside. Are we reaching the limits of the CTA buying? How much more is there still to come throughout the rest of this week? Is the short squeeze now largely done? Have we unwound that position? Have we gone from a sort of under-owned to overbought quite quickly? Yes, and are we still vulnerable to headlines out of the Middle East? Because we might be doing our best to move on and trying very hard to do that, but we'll see whether that's sustained if we get further news flow. And we're still waiting for confirmation of when these follow-up ceasefire talks are going to be. Could they be in the next couple of days? We'll wait for confirmation there. Coming up on the Owning Trade, we will bring you the start of the European trading day. Futures are pretty mixed this morning. This is Bloomberg.
Wednesday morning, good morning. How are you doing? A couple of minutes to go until the start of cash equity trading here in Europe. Let's give you a little bit of context. Talk about yesterday. Yesterday, really solid session, particularly over in the United States. The S&P, the Nasdaq, both rallying really strongly. The Dow, a little bit of a laggard. The energy story there, maybe a little bit of a break being put on that average. So this was the session yesterday. Europe priced in most of the gains. The US ticked up a little bit, but basically the back end half of the session in the States yesterday was certainly a little tighter. So we've got a little bit to price in on the upside. The problem with this morning, and let's show you some European futures, is that basically what we've got is a few heavyweight earnings that may actually just take enough out of the European markets this morning to kind of compensate for that upside that we got out of the States yesterday. So Eurostoxx 50 futures are down. ASML is a big chunk of that. CAC futures are down. The luxury sector is a big chunk of that. The Amsterdam market is down. ASML is a big chunk of that. So basically you're seeing the earnings story out, sort of balancing out maybe a little bit of the upside we had to price in out of the United States. US futures are also fairly flat. But at the moment, what we have is a market that's going to drift a little bit softer after a strong day yesterday here in Europe, Anna. Yeah, absolutely. Let's get a bit more on some of those stocks and sectors in focus then. The luxury space, certainly. Kering could be weaker. We got a Gucci comparable sales drop of 8%. That was worse than the 4% anticipated. Watching Hermes in that sector as well. Really interesting detail on the Middle East and the extent to which that has taken a chunk out of tourism sales. ASML also very much in focus, raising its full year sales guidance, but will the market focus a little on the Q2 guidance? Insurers also in focus. Aegon is selling its UK arm to Standard Life for £2 billion. Helvetia, also some news there. Others within that sector as well. Guy. Okay. Here we go. Let's show you some markets. Let's give you an idea of what is going on. We think we're going to be a little bit softer. The FTSE may do a little bit better, but certainly some of the continental markets, like the AEX and the CAC, could be under a little bit of pressure. So the FTSE's out of the gate fairly flat. We are up by 0.1%. I expect the CAC maybe to open a little bit softer. We put the AEX on the board this morning just to get an ASML early read. The expectation there is it's going to go down, but just be aware of the context. Get the 1 year board up and just look at the rally that we've seen, particularly in that stock over the last last few weeks, months, but particularly over the last few days as well. So at the moment, we're not getting clear indications. Clearly, nothing is happening in Germany. It is out early. The AEX is flat. We're expecting it to go a little bit softer. The IBEX is doing absolutely nothing. So basically, what we are doing this morning is holding the gains of yesterday. Where does the next catalyst come from? We've had this huge move from one side of the boat to the other side of the boat, from risk off to risk on. Is that now satisfied? Have the CTAs bought enough? Have the shorts been squeezed enough? Is that move over? And if so, what comes next, Anna, I think is going to be critical. And will that be the earnings season?
Yes, and we're not getting a huge amount of direction as the market asks itself all those important questions. So Stock 600, as you say, really very flat this morning, not seeing a move there. The CAC 40 is not yet open, and I see that we're halted on Hermes. So we're certainly keeping an eye on that one. Kering has opened and it's down by 5.6%. So there's a negative take on the Kering numbers. That's not a surprise given what the ADRs did in the States yesterday. Looking for the move in Hermes at the start of trade then. No surprise that even without the Hermes move, consumer products and services, which includes the luxury sector, is the worst performing across Europe. We see some of the Swiss names going lower on the back of that. So even though we've had LVMH already, it seems that there's further downside for that sector. We are seeing about a third of sectors in negative territory, 2/3 to the upside. There's still room for autos and parts to gain and be the best performer. There's no earnings there, and they maybe are part of that other theme, which is about markets trying to move on from being completely obsessed with what's going on in the Middle East. Oil prices are incredibly stable this morning, Guy.
Incredible, yeah. ASML is also incredibly stable. Can I just point that one out?
Yes.
ASML is not doing anything at the moment.
Yeah.
It is in and out of positive and negative territory. We were expecting a much more negative read on that. This is a stock that's rallied really quite significantly. Is the market ignoring the Q2 kind of outlook shortfall and focusing therefore maybe on the full year story and seeing that as a better sort of metric going forward? In terms of the kind of the bigger, you're seeing a move into pharma this morning, which I think is interesting. Bit of safety maybe coming through there. Luxury, as you say, like Richemont, LVMH, Kering, all under pressure this morning.
I thought it was interesting in the ASML numbers that they did say that they thought that they could handle any changes in the restrictions on the business they can do in China within the guidance that they have now put out. So I don't know whether that gives the market any comfort. But yeah, ASML flat to negative right now, still waiting on Hermes, and we will get an opening price on that one as soon as it is no longer halted. Let us get some analysis now of these markets. Louise Dudley, Global Equities Portfolio Manager over at Federated Hermes, is with us. And Louise, I wait for Hermes to open up so that we can talk about the earnings stories. So let's focus on the wider markets and what's happening here. The attempts to move on from thinking about only what's going on in the Middle East from a market's perspective. European stocks haven't caught up with where they were pre-war, but other regions seem to be doing a better job of that. Are we right to try and look through what is still a blockade in the Strait of Hormuz?
I think we've been a bit surprised with the US move that things have gone so risk on so rapidly. It does seem a bit extreme, particularly ahead of earnings. I think we were kind of going into earnings thinking, valuations are off, therefore the potential for upside where companies do deliver and maybe do confirm their kind of positive forward guidance. Now, particularly in the US, where things have moved up again, now we're saying, okay, well, could they deliver into that valuations where things were before, whereas things actually are a bit weaker generally, and particularly in terms of kind of interest rates. That's a kind of a binary indicator that has changed. That's something that's going to impact a lot of companies. That said, in Europe, what we have seen from some of the industrials that have already reported, they've actually reported quite well, and in particular, some strength out of China. So maybe looking towards ASML and their China move, maybe it's not as bad as we thought, and actually China actually has been getting on, and actually from a kind of a conflict perspective, China, relative to some of the other economies, particularly in Europe, is able to overcome some of those kind of near-term price impacts on energy.
So that sort of weaves together the impact of the war and what we're starting to hear from corporates. So let's think about that, because we do have an opening price on Hermes now, down by 11%, nearly 12%, in fact, this morning. So real negativity around that company, and this is a sector that's already been beaten up. We kind of saw this coming. We knew that there would be an impact of the war on the luxury sector, and yet it's still under pressure. What do we read into that earnings story?
Yeah, I think it's a case that, people will react to the negative numbers, and I think there's always some optimism around LVMH in terms of Asia that offset. Certainly for the larger businesses that are more diversified globally, generally they are looking to other regions to offset if there is particular weakness from Middle East. Obviously, for the luxury segment, Middle East is so significant that then it's obviously come through pretty negatively and expected to maybe persist as well, I guess.
That is the biggest downside move in Hermes since 2010.
That is a long time ago.
So we haven't seen a move like this in this particular stock, which has been the one with the halo in the luxury sector. It hasn't had the volatility. It's had the long the long waiting list. 2010, October 2010.
And when we talked about LVMH earlier this week, we talked to Andrea Felsted, and she was already seeing chinks in the armour of Hermes, talking about how this had been a business that you could almost not compete with because the waiting list was so long. But now she was sensing that maybe there was some more competition coming through. I mean, maybe it's too early to tell that story, but maybe that's in the back of the market's mind this morning.
There's a potential. There's a lot of unwinding potential. Therefore, you could argue around that stock. Yelena was talking about this being the sort of the anti-AI trade. So that gives me the segue to talk about the AI trade. Can I just go back? Can I ignore the war and just go back to trading AI? Because that's what the market seems to be doing right now. We're back to the semiconductor indexes are absolutely rocketing higher in the United States. Everybody just wants to get back to that narrative.
Yeah, I think certainly it's an area of the market that's showing some of the best, most kind of consistent growth. And that is a story that is continuing, and obviously a lot of that is US centric, so to a certain extent it is somewhat isolated from the crisis.
And Asia centric as well. Like you look at what's happening in Korea, Taiwan, etc. Those stocks have been again rocketing. Europe feels like it's being left out right now.
Yeah, definitely. And I think we're kind of seeing, Korea, Taiwan, those numbers have been quite solid and people are feeling more optimistic again. I think that's also part of the kind of risk on, particularly for Korea type trade. And, I think our expectation actually, so we do have an overweight in terms of Korea, and we do expect that is a region that is going to continue to do well off the back of, the constrained supply that we have at the moment within that kind of AI trade.
Let's think about the AI opportunities a little more then. And infrastructure is a very associated opportunity, and you talk about that in your notes, Louise, as being an area of focus. Data centers, grids, materials, the wider AI supply chain. Where in that supply chain do you find most exciting at this point?
To be honest, we are quite diversified. I think that's one of the things that's quite important, is that we don't really know who are going to be the key winners in terms of individual models and things like that. And so at the moment, it is a case of build for whoever, to a certain extent. There's certainly obviously lots of money yet to be spent. We would kind of err on the side of diversification within that bucket. It's also part of the broadening trend as well. At the point that obviously you've got the concentration at the top end of the market at the start of the year, everyone wants to talk about broadening. I think that is coming back into focus, and certainly that's where we're positioned as well.
How do you feel about rate hikes?
So at the moment, obviously, things have maybe come down to flat, as it were. And I think,
the ECB's priced for hikes, potentially, maybe in June, but not April. But do I avoid Europe if the ECB hikes rates? Do I buy the US if the Fed doesn't?
I think that's an underlying story in the sense that there's obviously differentials there, but I think because there's difference in terms of growth rates and valuations as well, I think the interest rate story is different. I think the dynamics within the US in terms of the change of the chair and things like that, I think is going to play into a lot more of the concern around what's going to happen there, and whether things get pressured, and that will upset the market if that does happen. I think in Europe things feel a bit more stable, and there'll be more rational outlook around what will need to happen, and therefore be less of a surprise, perhaps.
Yeah, I wonder how the AI, spending on the AI and the cybersecurity spaces are linked, because at one point it seemed as if companies were maybe prioritising AI R&D development spend and not maybe cyber. But then since we've had recent releases and a lot of warnings about cyber risks created by the power of some of these AI tools, how much do we need to focus on cybersecurity then, Louise? Is that a sector that we could see a step change in demand for?
Yeah, certainly that's what we think, and that's where we're seeing actually opportunities, that those are areas that are potentially vulnerable, and that is a kind of a necessary spend for businesses at the point that companies can slow down some of their AI innovation potentially if they need to. Cyber is not an area that they can do that, and they have ongoing contracts, and there'll be ongoing kind of price increases that come with that. There's also a huge backlog in terms of demand for people wanting those services, and now with the geopolitical space as it is, there is even more risk, and I think different businesses being targeted and being aware of how important that is going to continue to persist as a trend.
Louise, nice to see you. Thank you very much indeed for coming to see us. Louise Dudley, Global Equities Portfolio Manager, joining us from Federated Hermes. Let's take a look at what the market's doing this morning. What is LVMH doing on the back of Hermes? What is ASML doing? ASML is now up by 0.5%. Choppy start. It's been down a bit, been up a bit, but we are now up. We're looking through maybe Q2. You are seeing the luxury space under a little bit of pressure. So let's get some more detail on what is happening with those luxury names. Chloe's here with just that.
Good morning, Guy. Indeed, as you just mentioned, this luxury sector is red across the board this morning. We had some disappointing results from both Hermes and Kering that flagged really the impact of the war in the Middle East on those sales. And so this is really dragging down those disappointing results, dragging down the rest of that luxury sector this morning, with LVMH and Christian Dior also in the red. And it's really dimming the hopes of a luxury rebound anytime soon. And now that recovery definitely looks a little bit further away. Moving on to Stellantis, which is up. It's in the green this morning after reporting shipments of significant rise in shipments in the first quarter, and that was led in particular by a good performance in North America. So that'll be really taken as a sign that the turnaround, the ongoing turnaround for Stellantis is working, and the refocus on the US market is definitely taking shape. And so we are up about 3.5% for Stellantis this morning. It's also a good day today for the house builder Barratt Redrow. It said that we could expect some construction cost inflation from those higher energy costs to come in a little bit later, around 2027, but that the impact will actually be quite limited in 2026. So that is seen as quite reassuring. It maintained its guidance, and therefore we're up about 2.5%. And finally, Extron, which is a supplier of chip-making equipment, is also up this morning after raising its sales forecast. Quite interesting in the context of its much bigger peer, ASML, also raising its full-year sales forecast, but not getting as strong of a reaction from the market. But for Extron, we are up more than 10% this morning.
Chloe, thank you. Chloe Melly with the important detail that I missed around the auto sector. So I was thinking there was no news, and there was news. And that is part of the reason why we're seeing strength coming through then, as Chloe was saying, in the Stellantis story, and that may be lifting the rest of the market. So Stellantis up by more than 3%. But we are still trading these two themes, aren't we? Trying to move on from the war, but also the earnings story front and centre. Yeah.
And energy is reasonably mixed this morning. Brent is actually just a little tick higher, but not by much. We're kind of flat there, but we're still up by circa 40%. Up by nearly 55% year to date. So kind of that story there. Metals are up a little bit. So that inflation story is not going away.
Yeah.
But the market just doesn't want to think about it.
It's a weird day when you've got healthcare and autos as the best performing sectors. That's quite the pair. Coming up on the programme, we'll get more details on ASML, which faces a major blow in China as new US legislation threatens to block tool sales and servicing existing equipment in its top market. We'll get the context there. This is Bloomberg. Welcome back to the opening trade. 17 minutes into a European earnings session that is trying hard to move past a focus on war in the Middle East, but finding the earnings story is standing somewhat in its way of going higher. So European equity markets are pretty flat this morning. US equity market futures are flat to negative right now. This is a look then at a fairly flat market overall. The Dutch market, though, is not flat. The Dutch market is negative, and we have a negative picture for ASML and the shares there.
Do we? It's up.
Oh, that happened quick.
Well, it was negative, then it went up by around 0.5%. Now we're back to being up around, let's call it 1/10%.
Okay, there you go. It's on the screen now.
Flat. Let's call it flat. We are neither up nor down in terms of what we're seeing with ASML this morning. It's raised its full-year sales forecast. That's, of course, on surging AI spending. Q2, maybe a more cautious approach. Charlotte Hughes-Morgan joins us from Amsterdam. The market can't make up its mind on what the takeaway is here, but we're kind of flat after a decent rally over the last few days. So what is the takeaway from these numbers?
It's a good question. Yeah, we're seeing quite a muted response from the share price in Amsterdam this morning, which is quite extraordinary, I think, when you think actually that, they upped their full year net sales guidance. They now expect 36 billion euros to 40 billion euros. I think it really speaks to how much optimism was already baked in. I mean, ASML share price has already risen around 40% since the beginning of this year. We've had customers like TSMC, SK Hynix, Samsung all commit to these huge capex spending pledges. They're pouring money into this AI infrastructure. There's so much money going into data centers. We've had all these commitments already. So perhaps there is an element of ASML shares have already risen so much. So actually, even raising their full year guidance has not had as much of an impact as we'd expect. I mean, the message from ASML is very clear. They're saying AI demand for these AI chips is outstripping supply. They say we are working with customers to ramp up our own assembly capacity, but really, this is the story about the AI boom. It continues unabated.
Okay, and what about the China story as part of this then, Charlotte? Good morning, because we've heard from the company a little bit about that, but not a huge amount. And I think that the Dutch Prime Minister has a meeting planned with the US government to talk about export curbs, US export curbs that are affecting the ASML business.
Yeah, I mean, this is really interesting for ASML. And as you said, there's not a huge amount from management in the statement alongside results. No doubt analysts will be asking questions later on in the day. What they do say is that this updated full-year guidance, the 36 billion to 40 billion euros, kind of accounts for any potential outcomes of these, potential further export controls. So obviously, the US legislation is in its early stages. There's a lot of conversations to happen before we see implementation. I mean, something to note from this set of results is that actually net system sales to China were 19% of ASML's total net system sales. That's down from 36% in the last quarter. So actually, we're seeing the number of systems sold to the country falling in this quarter. And I think it's also important to reiterate that actually ASML is already under quite tight export restrictions to China. They've never been able to sell their most advanced lithography machines to the country. And so, further tightening these controls will certainly have an impact on revenue for their older generation of machines. It's definitely something that is important and that ASML will be working on. And as you said, Dutch Prime Minister went to the US and said he'd spoken to the Trump administration about these export controls this week. So it's definitely something the market is watching, but we did see a drop-off in those in the number of systems ASML sold to China this quarter.
What else is management saying? It all seems to be on track at the moment. China's a bit of a kind of sort of difficult one to read. They're not giving us some of the key KPIs that we used to get. So what are we learning from management this morning? What are they telling us other than the kind of the big picture story?
I think something that is important, and I expect we'll see this later, is that can supply meet demand? I expect we'll see analysts digging into this later. ASML saying we expect to be able to deliver enough capacity in 2026 and next year. But actually, I think with the demand kind of at the rate that it's going, I think there'll be some questions, that management will likely expand on. How are they going to ramp up capacity in time? I mean, ASML machines take years to make. They're extremely expensive. How are they going to match that demand story? And management have said, we're working with clients. We're comfortable. We won't be a bottleneck. But I think that will be something the market will watch. And obviously, we'll also be looking out for, their comments on macro events as well. There was no mention of Iran and of the shipping constraints. So that'll be something we'll dig into later. But I think, as I said, the main message here is that AI infrastructure story is kind of still booming. It's still going through the recent roof, and ASML is reaping the rewards of that.
Yeah, a lot of the commentary was pretty positive, wasn't it, from the management around that bigger picture. Charlotte, thank you. Bloomberg's Charlotte Hughes-Morgan joining us there from Amsterdam. Now, Bloomberg has learned that PIMCO bought $400 million of bonds issued by a Blue Owl Capital private credit fund. The purchase is a vote of confidence, then, perhaps, for the industry that's recently been battered by record redemption requests and deepening concerns over valuations, liquidity and transparency. For more, let's bring in Sinead Cruz, senior editor of Bloomberg's Going Private newsletter. She's had a busy time of it recently. Sinead, good to speak to you. So what's been happening in private credit then? As we focus on this Blue Owl story, is that the right way to view this, a vote of confidence?
Well, yeah, let's look at it as a vote of confidence. These are two, we've seen two examples of private credit funds that have been under severe strain in recent months, getting some love out of the public debt market. So we saw, obviously, Blue Owl selling this chunk of bonds to PIMCO, demonstrating continued sustained institutional appetite in the asset class. We still have a lot of retail money trapped behind the gates. That could still lead to some problems for some of these credit funds. And but maybe, just maybe, we might be seeing a change in sentiment towards these vehicles.
Some people are pretty positive still about what is happening. I was listening to all of the Wall Street CEOs talking about it yesterday. Jamie Dimon's comments really stood out. Let's take a listen to what he had to say.
There will be a credit cycle one day, and I think when there's a credit cycle, losses will be worse than people expect relative to the scenario. I don't think it's systemic. It almost can't be systemic at that size relative to anything else. But, you know, when recessions happen and values go down and people refi at higher rates, there'll be stress and strain in the system.
There will be a credit cycle at some point. But for now, I have to say, Jamie sounds quite positive. He's not worried.
Yeah, most of Wall Street, in fact, are pretty sanguine about their private credit exposures. They do represent, let's remember, tiny percentages of their overall lending.
Yep.
Wells Fargo yesterday said that they had just over 36 billion out of a 210 billion portfolio of lending to non-bank financials. So private credit is tiny. However, it is still causing some concern among some major watchdogs and authorities out there. Earlier this week, we saw Andrew Bailey, chair of the Financial Stability Board, and obviously Bank of England governor, saying that he's worried still about how the opacity in this marketplace could infect and inflame sentiment. And if that happens, all we need is another macro shock to knock the confidence and again trigger a doom loop of concern about these assets.
Just briefly then, Sinead, I mean, is more transparency what we need? I mean, there's private in the title for a reason.
Yeah. Look, disclosures, transparency will always help to calm and reassure investors. Just whether or not we'll get that and at what kind of standard is still to be seen.
OK, Sinead, thank you very much. Sinead Cruz, editor of Bloomberg's Going Private newsletter, which is published twice a week. You can head to bloomberg.com/newsletters to subscribe. There you go. Information on your screen about that. I mean, maybe we get to go back to talking about private credit now, and we get to talk about AI and all the other things we talked about in January and February. I'm finding it difficult to remember what we talked about in January and February.
I think you just nailed it.
Those
AI and private credit.
Gold, a lot.
There was a lot of gold. Gold seems to have definitely faded off the agenda, but AI seems to be back.
And the dollar has rethought recent gains, so that's in keeping with a move back to January, February, isn't it? 8:26 here in London. When we come back, we will focus back in on the energy markets. Is it too early to sound the all clear? We still have closure of the Strait of Hormuz. Well, almost. I mean, some vessels are now getting through, but blockades on both sides still in place. We'll be joined by Emily Ashford, Head of Energy Research at Standard Chartered Bank, to discuss the latest on the Middle East. That's next. This is Bloomberg. Welcome back, everybody. This is the opening trade, the middle of the week, and this is where we are, 30 minutes into today's session. We are entirely flat on the Stock 600, but that really does hide some really interesting developments. There's a couple of themes that we're trading around here. One is trying to move on from what's been a huge focus on the Middle East, rightly, over the last 6 weeks or so. The other is factoring in some earnings stories, and you see both of these demonstrated here on this board. The FTSE and the DAX trying their best to move on. Not a huge amount of earnings stories coming out of those markets today. The CAC 40, though, weighed down by certainly what we hearing out of the luxury sector. And that does link back to Iran, but the CAC Iran down by 0.6%. Hermes in particular, one of the big fallers there. Guy, that's the overall picture on markets. Not really telling the interesting stories beneath, but there are some.
There are. This is a market that's fairly balanced this morning. So 319 up, 258 sort of down. Reasonably balanced, let's call it that. But what is interesting once again is the volume picture. Very focused volume in terms of the buying over the last few days, which tells you a lot about what is maybe happening here in terms of the repositioning this market is doing and who is doing it. Is it the CTAs? Is it these short squeeze that we've been talking about? Is that what has been driving this repositioning? Is fundamental money actually convinced that this rally has legs? And I question that, judging by some of the notes that I'm reading at the moment. Let's talk about what we're seeing in terms of some of the leaders and the laggards. What we are getting this morning is a positive picture out of Rio. The metals market still looks fairly solid at the moment. Novo, the farmers are really on the front foot this morning, which again I think is really interesting in terms of where markets are repositioning to. Extron out with numbers, and that stock is definitely being rewarded very strongly, up by 13.1%. The downside, Anna's already mentioned it, the luxury space is under significant pressure. You can see it from Burberry down 3% to Kering, which is down by 8.5%, to Hermes, which is down by 12%. You haven't seen a move like this for nearly 20 years in Hermes. You haven't seen this for such a long time. Hermes feels like maybe the incredible run that it's had is beginning to run out of steam, Anna.
Guy, let's get up to date with some of the other stories that we are covering then this morning. Vice President J.D. Vance has pushed back on the Pope's criticism of the war in Iran. Last week, Pope Leo said anyone who is a disciple of Christ, the Prince of Peace, is never on the side of those who once wielded the sword and today drop bombs. Vance, who himself is a Catholic, said that the pontiff should be, quote, careful with his words. Bloomberg understands Anthropic has received several offers from investors for a new funding round that could value it at more than $800 billion or higher. The offers would more than double the $350 billion pre-money valuation that Anthropic had attached to its $30 billion fundraising in February. Bloomberg previously reported the company has discussed a public listing as soon as October. And US Treasury Secretary Scott Bessent says President Trump's tariffs may be restored by July to the levels in place before the Supreme Court struck down many of his levies. Speaking at a Wall Street Journal event in Washington, Bessent said the administration is seeking to implement or conduct Section 301 investigations, including probes into other nations' industrial overcapacity and forced labor practice. These, he indicated, could give the U.S. cause to implement new tariffs.
Okay. Let's get back and talk about what is happening in reaction to all of this and oil prices. Let's take a look at what is happening here. So oil prices currently are up a little bit. You've got the US contract up a little bit more. Brent is on the move this morning. But relative to recent moves, we are seeing something that is reasonably stable. Elsewhere, markets are definitely trying to move on. Can the oil market move on? And what is happening, particularly at the front end and at prompt delivery? The US and Iran apparently seeking further ceasefire talks, though I haven't actually heard much from Iran on that front over the last few days. The blockage in the Strait of Hormuz is continuing and continues to impede energy supplies. Emily Ashford, head of energy research at Standard Chartered, joining us now to discuss. Emily, the rest of the financial markets seem to want to move on from this war. Is the oil market moving on from this war and this blockade?
Not quite yet, Guy. We've seen a slight lull in bombardment from both sides, and we have this cautious and fragile ceasefire that's remaining in place. And I think despite the failure of the first round of talks to generate a notable shift in position for either side, even just getting those two parties in the same room is an achievement. We're taking a bit of comfort from the idea that we could see further talks in the coming days before this 2-week ceasefire expires. There are still several negotiating points, which I think both sides are at odds. The most critical to the energy market, as you mentioned, is the opening of the Strait of Hormuz. And that means opening with no tariffs, no naval escorts, no mines, and no risks to vessels. And I think the market is still a little confused over the logistics of this new secondary US blockade and really its strategic motive, because tightening energy supplies even further, well, that will mean higher prices for both crude and refined products. And that correlation between US gasoline prices and then the domestic backlash that we've seen to the conflict has been clear for the past several weeks. But in terms of the Strait of Hormuz, at the moment, what the market is doing is we are all watching individual vessels on marine tracking apps. One yesterday that appeared to transit and then turned back. And then we had a headline that Iran was said to be considering a pause in its own transits, which would then remove the transit of Iranian crude as well, and an extra 1.5 to 1.8 million barrels a day from global supply. And then this morning we've had another news story that a tanker has entered the Strait and made it to Iranian waters. But I would say on balance, it's a slight optimism about further talks that is really keeping the market sitting around $95 for Brent at the moment.
Emily, if I want a barrel of oil now, how much is it going to cost me?
Well, that's a very good question. We have seen a disconnect between the physical market for barrels, if we look at, say, dated Brent, for example, and then the financial market. And I think that might be one of the reasons why the physical market is still in panic, but the financial market shows a little bit more caution, I think, cautious optimism. If we're looking at barrels, if you wanted to obtain a barrel in the market, and one of the questions that I've been asked a lot recently has been about alternate sources of supply. And we saw a headline yesterday from President Trump talking about increasing UK oil production and the North Sea. There seems to be a little bit of confusion as to where barrels can be brought online very quickly. Most of that is really just from strategic reserves, and where we will see a gradual increase over time, because obviously higher prices does tend to lead to higher production outside the Gulf. But if you really want to obtain a barrel of oil at the moment, your best bet is probably going and looking from a barrel coming from a strategic reserve.
Emily, good morning. Can we say that we won't see shortages of anything in Europe related to the Strait of Hormuz in the energy arena? Will we see any shortages going into the summer, even if we do see gradual reopening of the Strait?
The only balance that we have to tighter supply is to reduce demand. So that is becoming increasingly evident. The IEA published a report yesterday suggesting that the Q2 demand drop will need to be on the scale of the COVID-related drop that we had in 2020. So we have tight crude supplies, tight feedstock supplies, and that means that we're seeing refiners, petrochemical producers curtailing their operating rates, particularly in Asia. And then on the other side, we're seeing flight cancellations, reducing jet demand. And remember that it was jet that saw the most acute price rises. And then governments have two ways that they can then reduce demand, either policies to reduce consumption or mechanisms to shield consumers from those wholesale prices. And to date, at least 43 countries have announced those measures. But really, only the opening of the Strait is going to prevent the most acute effects of energy supply loss and price escalation from spreading globally and then impacting the global economy.
I mean, that sounds like a huge ask, Emily, to reduce demand on the scale that we saw in COVID. Is that really what anybody is expecting? Or do we end up in a place where we just see some increase in exports from the Strait of Hormuz and then demand does not need to fall that far? Because that sounds pretty devastating.
Well, we've got a huge logistical lag that will be associated with this as well. When we finally have the Strait opening, vessels will be in the wrong locations. We've had shut-in supply from Gulf producers as well, so even getting that back on stream is going to take a long time. The idea that once the conflict ends, we will see a rapid return to normality, I think is wrong. And also, I think we're going to see a change in market behavior as well. There will be two key themes, in my view, energy security and optionality. So a longer term pivot in focus towards resource nationalism, maybe even hoarding. And that isn't just the replenishment of strategic reserves, but a new wave of stock building of both crude and refined products. And I think the conflict has also exposed the absence of optionality from both the upstream to the downstream. So I think we're going to see alternate offtake routes being explored. Most Gulf producers are unlikely to ever want to give Iran this much control over both global supply and the price of energy ever again, or to be exposed so significantly to just one single choke point.
Yep, it's going to take a while to fix that, maybe, though. Just on the strategic reserve front, how much is left? Like, if I want to barrel now, you said earlier I have to go to a strategic reserve. How much more can those reserves be drawn down without causing structural problems to the storage facilities, particularly in the United States? Yeah. If I want to rebuild them, presumably there's going to be extra demand afterwards as well. Just talk me through the kind of the process that is underway at the moment, and when that process kind of runs out of road.
Yeah, gradual withdrawals from strategic reserves. So we're not going to see 400 million barrels just put on the market on one day. And different reserves have different drawdown rates, the most rapid being the Strategic Petroleum Reserve. But other countries have more constrained rates there. And as you said, there are structural issues. So you can only withdraw a certain amount, particularly from the SPR, before you have to maintain an operational minimum level, or get an act of Congress as well to reduce volumes. And I think once the US removes its 172 million barrels, which is what it promised for those reserves, it is at that point. So I think removing any further from the SPR, once we see that drawn down, is limited. The one big reserve, which is opaque and we're not entirely sure how much is in it or how much is being drawn down, is China's reserves, estimated about 1.2 to 1.4 million barrels there. So China itself has been relatively well insulated from this whole situation with its strategic reserves. But that is the best repository of spare barrels in the market at the moment.
Yes, and so there's then some doubt as to whether the effect of this will be that China puts pressure on Iran or not. We will watch that one. I wonder, you mentioned earlier, Emily, that everybody in the industry is watching these various vessels and how much progress they make. We heard from the Americans yesterday that they said they successfully turned back 6 who'd been trying to leave the Strait. We're today watching the Agios Fanorios the First, which is not sanctioned. It's not Iran bound. It's heading to Basra, we understand. Is this the kind of thing that we should be watching to see the Iranian reaction function? Because if the Iranians don't seem to take any action against these vessels, and they can get in through Iranian waters, as they seem to be attempting to do, and crucially out again, that has to be a good positive sign, I suppose.
Yeah, I agree. I think there were a couple of risks to obviously this escalation with the blockade, and two critical ones for this. The deployment of more military vessels in the Strait, I think, obviously increases the operational risk of an incident that could even broaden maritime tensions outside the Gulf. And the second is whether or not vessels can transit. We still have potentially inspections or associated rise in freight and insurance costs. So watching this one vessel this morning that has gone into the Gulf, perhaps the US blockade doesn't see that as an export of Iranian crude, and so that is maybe why it's been allowed through. I doubt it's been able to get through covertly. The amount of focus on that area will be extreme at the moment. So yes, you're right. Maybe this is another thing that's giving the market a little bit of optimism that is not quite every single vessel being stopped, and that increased risk that we could see some sort of incident escalating again.
Yes, so the Agios seems to be Iraq bound, and you referenced there, Emily, another vessel that the Iranians have said managed to get into their waters, but we will, watch how it behaves and whether it manages to get out again. Emily Ashford, Head of Energy Research at Standard Chartered, thank you very much for your time this morning. 8:44 here in London. Coming up, a mixed bag for Wall Street banks as JP Morgan and Citi post record quarterly results. But Wells Fargo misses. We will look back and then forwards when it comes to the US banking story. This is Bloomberg.
Very resilient, through the last month. It's still up year on year every week. People are certainly spending more on gas than they were, before the conflict started earlier in March. But if you look in aggregate, it's about 3% of spend.
the Wells CFO, speaking to us yesterday. We're in the midst now, firmly in the midst of US bank reporting. Wells, a little bit of a wobble, you could argue, maybe yesterday. What is happening with the consumer? They're probably much more exposed than maybe some of the other banks. But the basic picture coming out of the US banking sector continues to be fairly solid. In some ways, kind of quarter on quarter, there's a bit of volatility in there. JPM, there's bits of that business that look kind of okay. There's bits that look fantastic. I look at trading, look at what is happening there. Bella Farr, who leads our finance coverage here in London, joins us now. So it's pretty positive for JPM, pretty positive for Citi. We'll come on to Wells in just a moment. But trading's really good.
Yeah.
And really good.
It's kind of ridiculously good. I mean, you saw... I think JP Morgan had record equities trading. They had, their second best FICC trading quarter, and they had record trading across the board. So clearly, I don't need to remind you that a lot has happened over the last 3 months through the end of March. Yeah. But that volatility definitely worked in their favor, right? They were able to reap the rewards from it for sure.
Yes, and we certainly saw that at some of those banks that did pretty well. Even the ones whose share prices maybe didn't reward that. We saw some incredible trading figures. What happened to Wells Fargo then? Something different, a different story entirely, it seemed, for the markets.
Yeah, so Wells Fargo missed estimates on both net interest income and non-interest income, right? So two key metrics that obviously analysts are always looking at, and especially for Wells Fargo that had kind of a key restriction from the U.S. lifted last year. So analysts are eyeing growth, right? And I think the question for Wells is, can they prolong this can they prolong this if volatility continues? If the U.S. consumer, starts to feel more pain at the gas pump, like you heard from the CFO earlier, will they be able to, sustain net interest income, or are they going to, be hurt by the fact that they are just not spending as much?
Yeah, it was interesting. The loan story coming out of JPM I thought was quite interesting as well, but we'll come back to that maybe a little bit later. B of A's out later, Morgan Stanley's out a little bit later. Does the theme continue?
Yeah, so I'll start with Morgan Stanley. Definitely expecting at least equities trading to be in line with the rest of the banks. I think it would be kind of a shock if something went awry there. But I think there will definitely be questions around private credit, which is something that all of the banks were asked about. I think, I was blogging JP Morgan's earnings yesterday. I think they were asked 3 or 4 times, maybe 5. Yep. So I think, but in terms of trading revenue, I don't think that they're expecting records on Morgan Stanley too. With Bank of America, they are expected a 6.5% rise in net interest income, which will be a big kind of boon for the bank. Again, I think all the questions will be around the consumer in the long term and whether, they start pulling back on spending or, they start to, their other parts of their businesses start to feel some of the hurt.
The doom and gloom that's coming out of things like UMich and things like that kind of actually become a reality. Actually, I think we're getting retail sales coming up, so maybe we'll get a better read on the consumer out of the US over the next few days, aside from the banks. Bella, nice to see you. Thanks for stopping by to see us. Bella Farr, who leads our finance coverage here in London. Let's talk about some of the European banks. The CEO of Commerzbank says she has had talks with UniCredit about a deal. This after the Italian bank announced the takeover bid, of course, for the German lender. But Bettina Orlop says the companies are still at odds over what the right valuation actually is.
We have constructive dialogues, at least from our perspective, since the beginning of the journey, so since September 2024, because UniCredit is an investor, an important investor, now the largest investor also, and we take that into account. So we had every quarter, we had bilaterals between the two institutions where we actually answered all questions UniCredit had, and we did not take up any feedback when it comes to our own strategy or to potential collaboration or something like that. And we always stated that we would be open for a dialogue when we see potential terms, potential ideas of a business combination agreement. And what happened after the announcement of the takeover offer is that we had some talks, some interactions about a potential business combination agreement, but for the time being, it's very clear that our opinions differ quite a lot, starting with the valuation of the two companies and to the banks and the exchange ratio. And there are also some disagreement, I would say, about the potential future business model.
That was Bettina Orlopp, CEO of Commerzbank, of course, talking about the different views on the value of that business provided by her management and that of UniCredit. Let's look at some of the events that are on the horizon for today's trading day. The IMF meetings carry on over in Washington. We have the bank earnings story out of the US that we've already discussed. The Bank of England's Bailey, the ECB's Schnabel, and other ECB voices will be speaking. There's basically a lot of focus in Washington of, I don't know what the collective noun for all of those finance professionals is, but there's lots of them in Washington this week.
I could have thoughts on that.
Yes, central bankers and finance ministers. We'll also hear from the Fed, of course, and it's the Fed's beige book. Let us think about what comes up next.
It's tax day, apparently, in America, which apparently is generally quite a negative day for equities, but yesterday was amazingly strong. Apparently, we've moved past the war, back to AI. That's fantastic. Can it last? Well, let's try and find out. Skylar's here. Can it last?
I mean, today, as you say, is a more negative day. This is work done by my colleague Simon White, and he looked at returns across every day, and today is, on average, the worst day of the year for the S&P. Now, generally, I wouldn't put a lot of weight behind seasonality unless there's a reason, but there's a very good reason for it in the fact that it's U.S. tax day. So people take out of the money out of the market to pay their taxes off. So that's more of a negative signal, but I think sentiment on average is quite positive still.
Well, yeah, and sentiment is quite positive because the market seems to be trying. The European story this morning seems to be we're trying on the one hand to look past what's going on in Iran. We have Brent almost entirely flat at 94.75. And yet the earnings story isn't helping us make move to the upside because of some of the luxury names. I mean, how are you summing up where we are in markets right now then, Skylar?
Yeah, it's really interesting because I think the market is just kind of pushing out negativity in terms of, yes, some of the earnings haven't been great today. And I think, markets can definitely look through into optimism if they're meant to be a resolution. And so the earnings aren't as bad maybe 2 quarters out. But if you actually look at first quarter and second quarter earnings, you might not see the negativity from higher energy prices in the first quarter. So first quarter Euro Stock's EPS expectations are pretty flat, and 2Q's actually been revised up. And there are two things when you look at a sector level happening kind of under the surface. The first is there's definitely more optimism priced into energy than negativity that's been priced elsewhere. So energy is meant to be very strong EPS upgrades and then since the Iran war began. And then the second impact is much of the impact that's actually being priced, even if not to the levels that I think is necessary, is in the second quarter, not the first quarter. So travel, for example, you've seen strong upgrades for first quarter EPS, but second quarter EPS is where you've seen the downgrade. So it may be that we have to wait till the second quarter earnings season to see that stagflationary impact.
Skylar, thank you very much. Skylar Montgomery-Coney from the Bloomberg Markets Live team. And that said, Guy, US futures flat to negative. So looking for another driver for the markets conversation, it would seem, over in the States.
Yeah, we've got to pay the tax bill first. So maybe that's
it.
Why.
Nobody wants to do anything today.
No, just pay the taxes, move on, and kind of... Then we'll figure out what happens next.
Listen to what some bank bosses have to say later, which will certainly be part of the conversation. And there'll be plenty of messaging coming from those IMF spring meetings as well. Kristalina Georgieva will be joining, of course, from the IMF. We'll also be hearing from Joachim Nagel over at the Bundesbank. So, of course, lots of conversations to come from the IMF events over in Washington. That is it for the opening trade. I'll be back with the Pulse shortly. This is Bloomberg.